but we're still talking about coronavirus because yesterday's release of the minutes from the last Fed meeting showed that Fed officials were mostly optimistic about U.S. and global economies and that they are prepared to hold interest rates steady at the current low level. But what does holding the line on rates mean for the long-term investor? Loreen Gilbert is the financial president at WealthWise, and she joins us from Irvine, California, with more on this. And we will talk about, they did address the potential for coronavirus to be an unknown going forward. But I'm curious, what do you say to investors when we have such artificially low interest rates on how they should protect themselves? Because I think the analogy is when someone's swimming with these kinds of rates, you can't see who isn't wearing trunks when the water's this high.
Right. Who could imagine the 30-year being under 2% when that's where we want to see the 10-year? So when it comes to investing, we do think rates are going to be low for longer, which can actually improve risk assets. So it's going to push up our risk assets, and that would be an equity play. So overall, we're saying to investors, be defensive in that going upward in capitalization towards large caps. If we look at year to date, it's still been a growth story over a value story as well.
Loreen, one of the things we've been talking about as it relates to coronavirus is trying to figure out what the ultimate impact, the economic impact is going to be. We were talking about the supply chains earlier this week, also about some of these exports being held up at ports because they're not able to ship out to China. Based on what you've assessed so far, how significant is the impact? Are we talking about this being just one quarter? Is it 2 quarters or a lot further out?
Well, if we compare the coronavirus to SARS, let's just take a look at that. So SARS in 2002, 2003, China only made up around 4% of global GDP. Today, China represents almost 20% of global GDP. That's a significant growth. So when you think about both the supply chain as well as demand, everything has been halted. If you look at not only shipping or manufacturing, but you also just look at business. We're talking about global conferences that have been canceled. We're looking at small companies that have been significantly impacted. So I think the reverberations of this global crisis is going to take a while to actually see the impact and the effect. And I think it will be probably in 2021 that we see that impact on the economy.
Jared Blicker here. I want to ask you about the U.S. dollar because it has been on a tear, strengthening versus a lot of currencies. We're seeing the euro at multi-year lows here. We saw this huge breakdown in the yen yesterday. What are the implications for a materially stronger U.S. dollar on the economy, the global economy?
Yeah. So, when we look at the global economy, the U.S. is still the best place to be. And with the dollar strengthening, that encourages that continued story of the U.S. We do think that eventually that will have to stop. We can't have a continuing strengthening dollar and look at our debt continuing to mount. Something has to change. So eventually we've got to see the dollar weakening. But for right now, like you said, there's the continuing dollar that's strengthening, and that means that U.S. will continue to do well.
All right. Loreen Gilbert, financial president at WealthWise. Good to have you here on The Move.
Thank you so much.